Well, if you were thinking of a housing crash, you got it. Right now, home sales fall in July as supply drops to nearly a quarter-century low. That's what we're going to talk about. We're going to go over why housing is crashing, but not prices. And I'm going to show you why bank earnings and all this interest rate with the Federal Reserve increasing rates the way they are is basically making catastrophic waves throughout the economic world, especially banks. So without further ado, my name is Dan Free. I do this report on a daily basis to keep you guys informed what's going on in the markets that's going to play a role in real estate. I don't know what's going on with real estate prices because it's so localized. It's like you can't just say, well, this market is crashing. Well, you might have a market that's across the country that's actually doing very well. So if you're out there looking for a house, please reach out to us. We'd love to help you get you set up with a realtor in your area. And without further ado, let's get over to the news. Here's what we have. But let me show you guys what's going on behind the scenes. We have 10-year treasuries falling as investors consider interest rate outlook. And then what you also have through here is S&P downgrades banks and so forth. So let me show you what's kind of going on. If you're an investor and you want just to park your money on the sidelines to get a safe return over the next maybe year or two, what are you going to do? And I'm contemplating this same thing. Well, I'm going to pull my money out of my savings account. Okay, so people are going to say, oh, that's a run on the banks. Well, no, I'm just using it. I'm taking it from my savings account, maybe putting it into some kind of bond. So when banks are starting to have liquidity issues, it's basically people are taking their money out of checking and savings accounts that are earning them 0.005, and they're moving them over to different accounts. Now, let's look at these different accounts that you can get into. So, for example, I can go into a 1-month treasury. A 1-month treasury. What's my yield on that? Well, it's 5.387. Okay, you're getting over a 5% return for tying up your money for a month. You go to 3 months, it's 5.4. If you go to 6 months, it's 5.5. Those are the sweet spots right now. Then as you go further on in duration, it goes down. Doesn't make any sense because if you're going to tie up your money for a long time, you want higher returns because you're tying up your money. So what people are doing right now, they're saying, okay, I'm not going to buy anything else, even if I'm wanting to get out of the stock market because, I think there might be a pullback. Where can I get some returns that's over inflation and not lose the value of my dollar? Right here. Okay, so why would you buy any other investments? Why would you buy corporate bonds? Why would you buy riskier bonds? What a bond is what mortgage rates are tied to are a bond, a mortgage bond. People are not buying mortgage bonds. They're flooding into this system because the Federal Reserve keeps raising rates on the short end of the yield curve, kind of screwing up the whole yield curve. Okay, so think about it. If you have this money, you can buy a mortgage-backed security, you can buy a corporate bond at basically the same yields, or you can put it into a 1 or 3 or 6 month treasury and get the same amount of yield with no default risk. That's what's happening behind the scenes right now. So people are moving their monies around, and that's what's really causing MBS prices and other bonds prices to go dramatically lower, pushing up the yields to the point where it's like, okay, well, when can I get yields higher, or when can I get a higher yield on maybe an MBS bond or a corporate bond than I can just in a money market or a treasury? That's what's happening right now, folks. So take advantage of this while you can. Lock up your money. I just pushed a chunk of money over into an 18-month CD, paying 5.5% interest rates. And I'm like, okay, that's cool. That's better than my 0.001 in my savings account. So I hope you understand, and I'm going to show you some more information next. So we see through here, another part of the problem with what we're seeing in housing is new shares of multi-built to rent properties. More and more and more companies are saying, okay, people aren't going to buy these properties. Well, we're going to buy them, or we're going to build for investors and then rent them. Then you're going to be at the mercy of the landlord. Look at the market shares of rental units for multifamily construction starts reached an all-time high of almost 98% for the second quarter. So we have tons of, we have realtors or contractors, builders still building units. On my way to work every day in Chicago, I pass by neighborhoods of multifamily built-to-rent homes or subdivisions getting put up. So if you're sitting on the sidelines, you're only going to be at the mercy of the rental markets for so long. So that's what's going on right now. So that kind of gives you an idea what's going on in the banking system. Now you have the S&P downgrading multiple banks, citing tough operating conditions. Well, we just went over those conditions with you. If their model was, they're getting earn, maybe 0.5 or 1% returns on their money, that we deposit in the bank. So think of how this works. You deposit your money in the bank, so you have access to it for checking, savings, and whatever. But the money just doesn't sit there. The bank uses that money for loans, credit cards, a whole bunch of other things. So look at credit card rates, 20, 25%. Look at the loan rates. You're talking mortgages in today's market, 8%. So when the banks are giving you 0.005% return on your money and they're lending it out at 8, 10, 20% interest rates, their profit margins are huge. But now the average consumer is getting a little savvy. They're saying, I'm not going to just sit my money or park my money in a savings or checking account. I'm going to move it around to different investment vehicles that are safe. U.S. Treasuries are never going to default. I won't say never, but the likelihood of them ever defaulting are basically, maybe less than 1%. So you can park it in an investment vehicle that's gaining 5 or 5.5%, or you can sit it in your checking account earning 0.0001%. So that's why all this stuff's going in. So when you really analyze some of the mainstream media data that you're getting, please read into the data so you don't think, oh man, banks are really getting crushed right now. No, people are just allocating their money into different spots. Okay, so that's what's going on right now. So let's get to the economic calendar for today to see what's coming out today that might affect mortgage rates, because that's what we have a focus in on, mortgage rates and programs to help you guys once you decide maybe I do want to see if I can buy a house in this market. Don't disqualify yourself. Please reach out to us, and I'm going to give you my information at the end of this video. But the only information that came in today is existing home sales. What existing home sales are houses that are already basically lived in. The person decides, well, I want to move. I want to sell my house and move to another house or do whatever they're going to do. That's an existing home. New construction are ones that are basically brand new construction. So you're seeing right through here that these numbers are dismal, as we had in the headlines just a minute ago. Existing home sales, the last reading was 4.16 million. It was expected to come in just a hair short of that at 4.15 million. It came in at 4.07, a big miss. Now, the Federal Reserve is going to love this because they're saying, okay, people can't afford housing again, so this is going to help the economy. Well, yes, you're helping the economy in some ways, trying to drive down inflation, but when you're jacking the interest rates to the moon and everything is costing us more because most of us charge it and then use other means to try to pay for that, it's only going to increase prices on all levels. So Federal Reserve, please sit back for just maybe 6 months and relax and see if all this trickles into effect, because even your words alone say it takes about 2 years for all these interest rate policies to take effect. So if you keep moving that pendulum up and up and up and never give it time to kind of sink in, at some point it's going to sink in and it's going to clobber the economy. That's why everybody's predicting, well, could there be a recession or could there not be a recession? Only time's going to tell on that. So let's get over to based on this information, what's the bond markets doing? So this is what I see on my screen on a daily basis. We look at the 10-year Treasury. 10-year Treasury's yields were down just a tick. People are sitting on the sidelines just waiting for the Federal Reserve to come out with any juicy data that they have for us. But you're seeing over through here and over in this section here, what's going on with the MBS market. The MBS market is basically a bond, like we were saying earlier. It's a bond that trades on Wall Street that competes against corporate bonds, treasuries, and things like that. So if you're not getting a good yield on this, mortgage-backed securities for the risk that you're taking, well, you're probably going to buy a treasury because it has no default risk and it has a higher yield. So what's happening right now are people are pushing down this price. No investors are buying MBSs. That's what's behind the scenes, folks. So until the Federal Reserve basically comes out of the equation and lets the short-term rates kind of go back down the normal where they should be, people aren't going to buy mortgage-backed securities. They might not even buy corporate bonds and a lot of other bonds when they can park their money into treasuries with much more security. So what you're seeing on the screen right now is what's going on in the price of the bond. This number right here represents that the price is down. So what we focus in on is, well, what's going to go on with rates? Well, if the price of a bond, any bond, could be a corporate bond, could be like here, we have on here a mortgage-backed security bond. If the price goes down, it has an inverse relationship or a yin-yang relationship with yields. So if the price goes down, rates go up. 0.05 is basically nothing. The market isn't going to change. So let's see where mortgage rates ended yesterday. We just hit a 52-week high, and here it is. So what you're seeing on your screen right now is where mortgage rates are today, the top 6 products people use when they're buying or refinancing a home. These rates are issued by Mortgage News Daily. Now, what they do is they analyze lenders all over the country, and they ask them this question. So you might say, Dan, that's not my rate. My rate's lower than that, or my rate's higher than that. Well, let me give you an idea how these rates work. How these rates are created is Mortgage News Daily surveys lenders all over the country and asks them 5 questions. If you had to borrow with these 5 criterias, what would the rate be? So one is they're buying their first house. It's their primary home, and it's a single family home. So that's the type of property it's going to be. The next is their credit score is 740, and they're putting down 20%. 20. I didn't say 3. I didn't say 5. I didn't say 10. I said 20. So that's the 5 characteristics. If that's you, then that's most likely where your rate's going to be. If you're not putting down as much money, well, your rates might be a little bit higher than that. If you're putting down a lot more money, you have a much better credit score and so forth, you might actually have a better rate. But again, remember guys, these are the national averages. How do you find out how we can help you? Well, go to therateupdate.com. I just changed our website a little bit to make it feel and look a little bit better. If you'd like our assistance, I'm a mortgage advisor, licensed in all 50 states as well as Puerto Rico. If you'd like to reach out to us and say, Dan, I'd like to see if I can maybe get pre-qualified for a house, or I'm just buried in debt. I have a ton of equity in my house, but I just have a ton of debt as well at those credit card rates at 25%, like you were saying. How can I get rid of those? We might be able to help you with a home equity loan. Or maybe you're out there and you're a senior citizen and you're just struggling. And you're like, Dan, I just need some help. I have a house that's free and clear, but the taxes, my medication, food, gasoline, utilities are killing me. How can I do it? Well, I specialize in VA or reverse mortgages. I would love to help you. So how do you reach out to us? There's 2 ways. One, you can give us a call at 844-775-LOAN. That's 844-775-5626. Or you can just click right through here to actually what you'll do here is go to the top. Let me go through this section here. And you'll go all the way to the top. And what you do, something is unique right here. When you hit the Apply Now button, most places are going to go to an application stage. We don't. We want to answer all the questions that you might have for us. If you don't have any questions, we're just going to answer, set up a consultation with you. And I'm sure you have a couple questions. Just go over your scenario, and then we're going to send you a link to apply online. We're basically trying to vet you up front to make sure you're not wasting your time and efforts trying to get a loan if you don't qualify. But what I want to do is make sure you don't disqualify yourself. So my name is Dan Free. I'm going to ask you to do 2 things for me today. One thing is if you find value in this video, please just give me a thumbs up. The next thing is if you haven't subscribed yet, please do. And the button is right down below. God bless, guys. Thanks so much for watching. See you tomorrow. Bye-bye.